Several indicators suggest that 2025 could potentially bring about one of the largest financial crises in recent history. Here are the primary reasons why this year is raising alarms among analysts and economists. 1. Mounting global debt, historic debt levels. Global debt has reached unprecedented levels, surpassing $300 trillion as of 2024, with both governments and corporations heavily reliant on borrowing. Rising interest rates. Central banks worldwide have increased interest rates to combat inflation, making debt repayment more expensive and pushing many into default. 2. Persistent inflation and economic stagnation. Stagflation. Risk. Many economies are grappling with slow growth coupled with persistent inflation, creating stagflation, a scenario difficult to address with conventional monetary policies. Erosion of purchasing power. Higher living costs and stagnant wages are squeezing middle and lower income households, leading to reduced consumer spending. 3. Real estate market weakness property. Bubble bursts. Real estate markets in countries like China, the U.S., and parts of Europe are showing signs of significant correction due to oversupply, high interest rates, and declining demand. Developers in crisis. Large real estate developers are facing insolvency, as seen in China's Evergrande and Country Garden crises, with ripple effects across global markets. 4. Banking system fragility. Tightened liquidity. The rapid withdrawal of stimulus measures and quantitative easing has reduced liquidity in the financial system, stressing banks and financial institutions. Shadow banking risks. The unregulated shadow banking sector is under strain, with interconnectedness to traditional banks posing systemic risks. 5. Geopolitical instability. Ongoing conflicts. Continued geopolitical tensions, such as those in Eastern Europe, the Middle East, and the Indo-Pacific, are disrupting global trade and increasing defense spending. Supply chain. Vulnerabilities. Trade restrictions and sanctions have created supply chain bottlenecks, driving up costs and reducing productivity. 6. Climate and resource challenges, economic disruption. Extreme weather events are causing significant damage to infrastructure, reducing agricultural output, and increasing insurance claims. Energy crisis. Transitioning to renewable energy has been slower than expected, leading to energy shortages and price volatility. 7. Financial market bubbles. Overvalued stocks. Despite economic weaknesses, stock markets have remained overvalued, fueled by speculative investments, especially in technology and artificial intelligence sectors. Crypto market volatility. While cryptocurrencies offer opportunities, their speculative nature could exacerbate financial instability during a crisis. 8. Demographic shifts. Aging populations. In developed nations, aging populations are increasing pension liabilities and healthcare costs, while shrinking workforces reduce economic productivity. Youth unemployment. Many developing nations face high youth unemployment, leading to social unrest and economic inefficiencies. 9. Central bank policy missteps, policy dilemmas. Central banks are struggling to balance inflation control with economic growth, risking either a deep recession or runaway inflation. Loss of trust. A prolonged inability to stabilize economies may lead to a loss of trust in traditional financial systems. 10. Globalization in retreat. Deglobalization. Trends. Rising protectionism and decoupling between major economies like the U.S. and China are fragmenting global trade, increasing inefficiencies, and raising costs. Why 2025 could be unique. Unlike previous crises that were regional or sector-specific, e.g., 2008's housing collapse, the risks in 2025 are interconnected and global. A simultaneous crisis in debt, markets, real estate, and geopolitics could create a feedback loop, amplifying the impact across multiple sectors and economies. Conclusion. While the extent and timing of a financial crisis are uncertain, the convergence of these factors in 2025 presents a scenario where even minor shocks could trigger widespread economic disruptions. Investors, businesses, and governments should prepare for volatility, reassess risk exposure, and prioritize resilience strategies.